Welcome to the Daily Brief, where I'll go over the highlights for the action in the market for Friday, December 23rd, and then we'll see how things look for Tuesday, December 27th. Please be reminded that on Monday, December 26th, the stock and bond markets will be closed, reopening again for more holiday trading going into next week. We had another kind of update. It was pretty choppy. It's helped a little bit in that it's worked off some of the oversold indicators that we were looking at and getting more to a neutral stance as far as where we're at on an oversold, overbought basis. But we're still looking quite negative technically, but we're coming into that time of the year when a lot of folks are expecting what's called the Santa Claus rally. So let's go back and talk about what happened. Right at the open, we did have a lower open, and we went down below the daily pivot at 38.13, and we came down to 3800. That is more psychological, but the more times that we play with the 3800 level, the more relevant that becomes as some kind of a support level. The market was able to stay above that, or at least find support. It dropped down a little bit below it, but for the most part, it stayed right at 3800 and then bounced higher. We rebounded back above the daily pivot and even the unchanged level, and then prices ended up going positive. As the day went on, we went down negative again, but then rebounded, and prices then chopped sideways while remaining positive. We closed almost at the high for the session. We were up 0.59%. It was a positive day, but not as big on a percentage basis as what we've been seeing. Volume is below average and declining, and now we're starting to shift into holiday mode. And so you'll probably see volume really trail off in the week between Christmas and New Year's, unless something really big happens. But even that, you've got folks that are on vacation. They've decided 2022 is almost over. It was a really challenging year for the stock market and a lot of markets for that matter. I just want to go home, enjoy my family, and come back at the beginning of 2023 and see what happens. Man, the technicals, as I said, are still negative overall. We really haven't improved, but we're kind of coming into this potential favorability as far as the Santa Claus rally is concerned. And I have a definition of that I'll show you here in just a moment. Inflation and interest rates and growth concerns, those are the real fixation right now. And that's really what's been driving the markets in 2022. And it doesn't really seem to be letting up for right now. It's probably going to carry over into 2023 as the debate goes back and forth about, were we in a recession? Are we in a recession? Are we going to be in a recession? And then what kind of a recession is it going to be if that even happens? So here is the intraday chart showing that we had the lower open below the daily pivot. After a few minutes, we came back above the daily pivot and actually came above the dashed line here, which is the unchanged level, spiked up a little bit, came back down, went slightly negative, and then just pretty much chopped in positive territory and closing almost at the high. Didn't quite hit that high level. So what are some comments that we can make? Friday was the first day of this period that we're calling the Santa Claus rally. It's the last 5 trading days of the year, plus the 2 first trading days of the new year. So the last week of 2022 and then the first 2 trading days of 2023. Can this continue? As I said, it's been a real challenging year. A lot of people are suffering losses. Can this rally come in and at least try to end things on a high note? The VIX is still acting kind of strange. It dropped with the upward movement, but on that ratio chart that I've been showing you, it's still continuing to go up. So I'll show you that again. A lot of this is coming about because of the earnings per share and the valuation concerns that maybe the stock market is too expensive. The earnings are going to be lowered, and that will ultimately lower stock prices. The US dollar did decline, which gave some support to stocks, but interest rates were pretty much up across the board, and that provided some headwinds. But that, coupled with a lot of people were gone and very low volume, the market just wanted to go a little bit higher. As far as our short-term oversold conditions, we have one area within the PMO studies, but all of the other areas, they have now been worked off. And in the intermediate term, the CCI 14, that's been taken off. And now we have the CCI 20 that's only showing an extreme negative reading. And even that is about ready to change. We still have our yield curves that are inverted, that have been inverted now for quite a while. Sentiment is still over in the fear area. We're not getting into the extreme fear, at least yet. We're not in neutral or positive territory, so we kind of lean more with what sentiment is saying until we get extreme. The economic reports that came out were personal income. It was up 0.4%, a little bit more than the 0.3% that was expected. Personal spending was up 0.1%, and that came in as expected. The PCE price index, it was up 0.1% on a month-over-month basis. That was lower than the 0.2% that was expected. When you take the core PCE, which takes out food and energy, all the things that you really need to live, it was up 0.2%, less than the 0.3% that was expected. When we look at this on a year-over-year basis, it's 5.5%, where the last time we had this report, it was at 6.1%. So that's dropped a little bit. And then the core is also lower than what we had last time at 5%. It came in this time at 4.7%. Durable goods, we're down 2.1%. That's showing some significant weakness, and it was a lot more than expected. They expected it to be down 1%. The last time we got this report, it was down 0.7%. If you take out transportation, it was up 0.2%, more than the expected 0.1%. The last time we had this report, it was up 0.1%. New home sales actually saw a little glimmer of hope, at least in the month-over-month basis. We were up 5.8%, and the seasonally adjusted annual rate of 640,000 units, which was more than the 600,000 they'd expected. The last time we had this report, it was at 605,000. And on a year-over-year basis, we're still down 15.3%. So we're seeing weakness in the new home sales, but this month was it was better than what they had expected. The consumer sentiment, the final reading that comes out from the University of Michigan, it came in at 59.7, which was a little better than the 59.1 that we had at the preliminary reading. Last time we had this come out, it was at 56.8. So a little bit of an improvement there, even though inflation is still kind of ruining people's happiness right now. But a year ago, we were at 70.6. So it's really dropped from where we were. And 70.6 is nothing all that great in and of itself. Our trend is still negative and weakening. We're still slightly below the moving average, so it's still going down. We're below 20, so that suggests a trendless environment. I've switched our bias over to being positive because we had 2 up days in a row, and I've changed our momentum over to mixed because maybe there's some hope that there might be a bit of a bounce in the week coming up. Here is the model chart that we're looking at going back to 2006 to 2008, where that's the green line, that if we stay with what already happened, with what this is suggesting, then we still might see some weakness going forward here. The VIX is still at a pretty low level. It's down in the low 20s and it's not really spiked yet. And if we really start to go down, you would expect the VIX to go up. Well, even when we've been going down, the VIX really hasn't been behaving all that much. This is kind of showing what I'm talking about, where if you take the VIX to the S&P 500 ratio, it is really starting to climb. And I put in the red lines here where other times we spiked up. And a lot of times, if you look at the bottom, that marked some kind of short to intermediate term weakness in the S&P. Not all the time, but certainly something that we should be aware of, and then use other indicators and other evaluation methods for what's going on at that time. If this spike goes up and then starts coming back down, we'll reevaluate things and say, is the market more likely to go down from here, sideways, or up? Then I didn't include this in the video for Friday's session, but we had the weekly report of the American Association of Individual Investors. they're starting to get extreme negative, and they've spent a lot of time down here. And so we've had a lot of triggers, because usually what happens when we start to get extreme negative, the contrarian method is to say, okay, most of these folks are not, they're not professional money managers, and they tend to be wrong a lot. So when they start to feel something in the extreme, we do the opposite. Well, we've had a lot of these signals in 2022, and we've seen some relief from that. And the individual investors have come through and saw prices go up. But to see so many signals down here at the bottom, where if you look back, yeah, there were some times when we were down in this low range, but usually it's a spike, we hit critical mass, and then we bounce up from there, where we've been camped down here for a lot of 2022. Here's the University of Michigan consumer sentiment given the final reading. We're still seeing a real spread between the 2-year yield, which here is coming down slightly, and consumer sentiment, which is going up. But down at the bottom, this is the spread between the two. And even though they're on different scales, they have a tendency not to get too far apart from each other, and they tend to go in the same direction. Well, in a lot of 2022, we're not really getting a lot of insight. Interest rates are high, and how people feel about things is low, where they tend to be closer to each other. Then here's the Ulcer Index, which also looks to measure fear. We're above the moving average, so we're tilting more towards the fear side. As this goes up, that means there's more fear, and we ticked up just a little bit in Friday's session. Here's the equity put call ratio. After giving us this really, really big spike a few days ago, it's been coming down overall on the daily chart, and it's starting to come down now on our 5 period. So we're going to have to see, is this a spike that we can work from? When we have a spike and we start coming down, a lot of times that marks a low in the S&P 500. Well, are we going to get that this time? Are we going to spike back up, or are we going to continue to go more sideways? Because we've had a lot of signals from this in 2022 that fizzled out pretty quickly. Here's just a longer term look at this chart, and you can see where I have it highlighted here. That's the current value of the 5 period moving average, and this is higher than what we've seen in quite some time. As far as our trend, it's trying to turn back up, but it's still below the moving average, and we're below 20, so we're in a trendless environment. The red line's on top and declining, but the red line makes us default to the negative side, and the green line also continues to decline. Here's our BPI. Didn't really move all that much. With the last couple of up days, we were actually down on Thursday and just minuscule changes on Friday. We're watching this to see if this topping pattern that we saw going into late November into December, is that going to mark a top in the BPI as we continue to go down? And just to remind you, the BPI takes the point and figure buy or sell signals inside of the S&P 500. It takes all of those stocks and then measures it as one indicator. And this can give us a pretty good insight as to what's going on internally in the S&P. Here's our PMO studies, where we're just coming out of being extreme negative with the PMOs that are rising. We're still extreme negative with the buy signals, and we continue to decline with those PMOs that are above zero. Here's our stochastics, not really showing anything, but since we were just extreme, I wanted to bring this chart up. We're no longer extreme in the short term. Intermediate term is showing some improvement, but we're still declining in the longer term. And again, just be reminded, this is a subdivision of the short term. Here's our double and triple exponential moving averages. We're still below this anchored moving average going back to the COVID low. If we do go up, that may provide some resistance. And here's the daily chart, where we're a little bit above the pivot level here. That's positive, but we're still below the 50 period moving average. That's negative. We want to see, can we get that back, or are we going to fall down, or are we going to continue to go sideways? And then at the bottom, you see where volume really dropped off in Friday's session. We're below all the moving averages in the moving average tree. So if we do have the ability to go back up here, we'll probably hit some resistance at these points. New highs, new lows. We saw a little bit of an advance in the new highs. They really started to show the new lows in Thursday session, but it was pretty muted in Friday session. The 5-period continues to decline, so that's also suggesting that we're seeing weakness inside the S&P, and the 10-period is still flat to slightly declining. Elder Impulse, it switched back to neutral. We had the up day, or it was a down day on Thursday, but we saw a pretty nice rebound intraday, and then combine that with the slight up day that we saw on Friday. So that just makes it more of a neutral reading. I'm trying to think back. I think Thursday was an up day and Friday were up days. The Swinland Trading Oscillator, it is showing some improvement after almost getting extreme negative based on price and volume. It's continuing to go up. And an interesting thing is when we had that big down day and then the rebound from that, the STO picked that up and it was still going up before that happened. So this is looking a little more positive. We're holding support currently with the Ichimoku cloud. And can we stay above this green cloud that may be providing some support, or are we going to fall down from it, or are we going to be able to go up higher? Short-term fib levels, we're back above this double short-term fib retracement level. So that's positive for now, but we've been bouncing around these lines now for a number of days. Longer term, we're just a little bit above this longer term double fib retracement level. So far support is holding, and it's a lot of it's being set at that 3,800 level. And then weekly, we're just a little bit above this 38.2% retracement. So far we've been holding up with that, and we're still above the 200-week moving average. We're a little bit under the midpoint of the trend channel, and so far that has been holding up, but it would be more positive if we could get back above the midpoint and then continue to go higher. One thing I wanted to point out is I haven't been covering a lot of the sectors lately, but we're starting to see a golden cross with the staples sector. This is what folks get into no matter what's going on in the economy. These are staples. These are things that you have to have. Toilet paper, toothpaste, soap, things like that people still need, where they don't necessarily need that, new entertainment system or that second vacation home, or something like that. That's more discretionary. That's what you do when times are good. Well, when times get more tight, the discretionary suffers and the staples tends to do fairly well. And so we're seeing this producing a golden cross and looking more positive. The Dow is still hanging above its moving averages, both the 50 and the 200, and we're working off of this golden cross. So this is positive, but we've been chopping sideways. Can the Dow stay above this? It's been a real leader in at least the last quarter or so of 2022. And if it goes higher, it might bring some of the other indexes with it, or it could fall down below this pivot. It could fall down below the moving averages and turn more negative. So what's our outlook then for Tuesday? The stock and bond markets will be closed on Monday in observance of Christmas. The technicals are negative, but we're trying to ask this question. We saw that nice rebound in Thursday's session. We saw a little bit of an up day on Friday. Can we see this Santa Claus rally continue throughout the rest of this week and into the beginning of 2023? We don't have any economic reports coming out on Tuesday. And we got the whole list of geopolitical events, but barring one of these other ones coming to the forefront, the markets are pretty much fixated on the inflation and interest rate scenario, which is producing growth concerns. So our scenarios, looking at the down scenario, can't really go with that one because even though the technicals are negative, we're working off being short-term oversold, and we're coming into this potential positive seasonality. We can't really go with the up scenario either, but we want to ask, can the rally continue? Our scenarios not really doing all that well. The sector rotation not really doing all that good. The setups not giving us any real extreme readings and still showing weakness overall. So we're just not looking all that positive, other than the fact that we may get some kind of Santa Claus rally. So the technicals, though, are still negative. So we can't really go with that positive scenario. we're hanging in there as far as our support level. That 3,800 level is holding up so far. But if we start to go up, we have moving averages above where we're at right now, which may act as resistance. The pivots, they've been holding up so far, but our fib retracements, they've been holding up. So we're just really chopping sideways, and there's really not a lot of conviction right now, even though we have a strong negative slant as far as our charts, but then positive seasonality potential that could take us into the end of the year. So we're still going with this sideways scenario because the ADX is still below the moving average. So it's weakening. It's below 20 and the red line's on top. So it's negative. So what's our conclusion? The S&P is negative overall. Short term, it's negative, and it's working off, or pretty much has worked off, that oversold condition or extreme negative condition. Intermediate term, it's just flat out negative. We have that one CCI chart that's extreme, and that's it right now. Long term, we're still negative as we continue to be below the 200-day simple moving average. And the longer we stay underneath that, the more negative it becomes. So just want to wish all of you a Merry Christmas. I hope you have a lot of enjoyable time with your family and your friends, maybe a chance to relax. This will be the last video that I post before Christmas. So I'll still be posting videos in the upcoming week, but I just want to wish all of you a happy, safe, and prosperous Christmas season before we get set to go into 2023. So thank you. Have a wonderful day, and I'll talk to you in the next video.